Here again with Smart System. In our last lesson, we finished up our series on technical indicators with a look at the parabolic SAR. In today's lesson, we're gonna start a new series on candlestick chart formations with a look at what these tell us about the supply and demand situation in the market. So let's get started. What a candlestick chart does is it uniquely represents the high-low opening close by connecting the high and the low with a thin line, and the open and the close are represented by the body of the candle, which is a thick part in the middle, which is shaded a different color, depending on where the close is, in relation to the open. So on most charting packages, if the close is higher than the open, then the body of the candle is shaded white, and if the close is lower than the open, then the body of the candle is shaded black. Now that may be red or green, the color doesn't really matter, as long as you understand which color represents a higher close than open, and which color represents a lower close than open. At their most basic, what candlestick charts are great at doing is giving you a picture of what the supply and demand situation was for one individual period of trading. So if you're looking at a daily chart, you know that the candle for the day gives you a good indication of whether buyers or sellers won the day and how much control they had throughout the trading period. Long white candles that are representative of a period where buyers started in control of the trading period and then remained in control as they drove prices up throughout the trading day. Black candles, on the other hand, represent a period of trading where sellers started in control of the trading and then dominated as they drove prices down throughout the trading period or the trading day. If you're looking at a daily chart, long wicks are representative of a trading period. There was a lot of action at the end of the day, was fairly close to the open for the trading period. And what long wicks tell you about trading action is basically if you've got a body of a candle, which is towards the top, and a long wick, which is on the bottom of the candlestick, then this is indicative of a market where the sellers initially were in control and pushed down to make that low there. But then the buyers regained control and pushed prices back up to close the day of the time period, whatever time period you're looking at, close to the open for that time period. Similarly, if the body of the candle's at the bottom and you've got a long wick at the top, then this is indicative of a period where the buyers were initially in control and then the sellers took back control and drove prices down to take back some of those gains and close the trading period closer to the open than them would have otherwise happened. Short candlesticks represent either no action, where there's not much trading going on at all, or can also represent an intense battle that neither buyers nor sellers have won, and that's gonna be kinda significant. If there's no action in the market, then a short candlestick doesn't really tell you anything. But if short candlesticks show up at places such as the top of a long uptrend or something like that, then that can be very indicative of a change in the tide, and that's what we're going to look at in our next lessons, is how you can, depending on where some of these patterns or where some of these candlesticks show up and how they show up on the chart, that tells us about the supply and demand situation, or that battle between buyers and sellers. And a lot of times what it tells us about the shifting tide that we may be able to place a trade with. So that's our lesson for today. As always, if you have any questions or comments, please feel free to leave them in the comment section. Have a great day.